Welcome to the Weekly Notebook Review. I am Robert McGroarty. This podcast takes on a bit of a different format where we are live each week on Twitter Spaces. I crack open my notebook and review Hedgeye research with anyone who wants to learn a better way to invest. We feature both Hedgeye power users as well as some special guests that might pop in. If you want to learn more about our research, visit hedgeye.com. If you'd like to participate in the live stream, follow me on Twitter at HedgeyeRJM. Now, let's review the data.
Another episode of Hedgeye and Friends here on a Thursday night, and almost the end of March 30th. I'm on the Amtrak on the beautiful Estella on the way back to Boston. But this show tonight is really all about munis, and I've got the wonderful guest with us tonight, a huge friend of the program, Brian Nurick. So thank you, Brian, for taking the time out and helping to coach everyone within Hedgeye Nation on fixed income and specifically muni bonds and how they can play a portion and a role inside of one's portfolio. So, Brian, thank you, sir. Appreciate you joining us.
Happy to do it. And first time being a co-host. I don't really know what that means, but...
And, well, don't let it go to your head, Brian. Don't let it go to your head. I'm just kidding. But for those listening in, again, this is Hedgeye and Friends, kind of like a spin-off of the weekly notebook review that we do, or that I host on Wednesday evenings at 4:30. And, the Friends piece, the Hedgeye and Friends, is really to expand beyond that, right? Like to go a little bit outside of the usual kind of notebook chat. And again, as I mentioned, this show or this episode today or this session is going to be all around fixed income. So bringing in some special guests like Mike Taylor in the past and Dr. Andrew Maneker and stuff like that, right? So again, Brian, it really is an honor. You have shared a ton of information on the Weekly Notebook Review, and you're very kind to do that, to come on and kind of give a broad update of the muni bond space. So for those that didn't catch that yesterday, I'd go encourage you to listen into yesterday's episode of Weekly Notebook Review from March 29th. But tonight, I mean, again, this is all about you. So why don't we maybe give the folks a little bit of a background, if you don't mind, Brian, in terms of just sort of not the full work history, obviously, but just I'm familiar with it because I've gotten to know you quite well over the last couple of years. But for those that might not be as familiar with Muni Guy, would you mind just sort of diving into a bit of your background?
Yeah, sure. Be happy to. So graduated college and went to work for Edward Jones, old wall firm, and went behind the ears in 1997, and was there for a little bit more than a year. Got my Series 763 and learned all about how to invest money the Edward Jones way. And then I ran into some folks who had a boutique firm in Cincinnati, Ohio, and Lexington, Kentucky, where in Cincinnati they underwrote and bought municipal bonds and resold them, as well as did some asset management. And then in Lexington, Kentucky, they focused on the financial advisor to the bond issuer, putting the bond together side of the business. So I took a job there and started off making very little, working 6 days a week, and just pounding the keyboard, running numbers all day. And after about 5 years, they kind of let me out of the office and actually go and meet a client. I was there for until about 2012, and I went to work for a publicly traded firm. Was there for 3 years. They got taken over by another company. They got purchased, and that's when we decided to go into business for ourselves. So I've been doing this for 25 years. Me and my two partners, we've been together for probably a little more than 20, probably about 22 years. And, what we do is we are a municipal advisor under Dodd-Frank, and we represent mostly school districts, cities and counties and utilities, bringing bond issues to market. And then at the firm level, in order to do this work, you have to sit for the Series 50 license. And then I'm one of two principals of the firm with the 24 license. So we're regulated by the SEC. So they come in, our friends at the SEC come in every 3 years and audit us. And, that's basically kind of my background. The investment side here with Hedgeye and me
So
contributing to
before you
this.
get into that, it's a great reminder, Brian, of anything you hear tonight is not investment advice, right, Brian?
Yes, the
And this is all
disclosure,
for
yes.
educational purposes. All for educational purposes only. And we hope you enjoy it, and we hope you learn from it. But please, this is not investment advice. So, Brian, I'll let you continue, but just need to get that in there.
Yeah, no, thank you for the reminder. Yes, nothing I say is investment advice. Things that I posted today in preparation for this are just, my personal opinions or experiences, may not be appropriate for you, and please consult whoever is your fiduciary before you make any decisions of that type. But my participation in Hedgeye is really just me, managing the family portfolio and just trying to give back and teach people about kind of a niche business that not really many people know about. And it's very rewarding to help a school district build, finance and build a school, and then be there for the groundbreaking and be there for the dedication and all the work that goes into it. But it's another thing to be on the other side where you're somebody who's actually buying that bond and receiving that single, double, or triple tax-free income. But in terms of what we do, just so you guys have an understanding of how we look at things, maybe a little bit differently than an investor, we give advice to as it relates to issuing the securities, the structure, the timing, the terms of the issuance, any other type of municipal product, investment strategies, credit rating management, post-sale continuing disclosure obligations, and then we, of course, monitor all their debt for refinancing opportunities. So a lot of my investment theories or things that I do revolve around my experiences with issuing the debt and then refinancing the debt and trying to find opportunities that may or may not prove to be fruitful over a longer term duration. So that's really kind of what we do as a municipal advisor, and that's why I'm kind of trying to help people understand municipal bonds and help people figure out whether or not they have a place in your process. Does that hit the points, Robert?
Yeah, no, it's wonderful rundown. And Brian, just for those that may not be as familiar with sort of the process that goes into the creating kind of a muni bond offering. Do you mind just expanding a little bit on? I know you mentioned kind of where you specialize in regards to in that arena of the business, but so just sort of some of the nuances or some of the I guess the steps that go into not only sourcing a deal, but then kind of getting it to market and how maybe that interaction. Again, we don't have to get too much into the nitty gritty, but just high level, just to give some folks some background.
I can I'll just talk about the last deal I did. So about 2 weeks ago, I sold $20.5 million for a South Carolina school district, and so we have a capital plan that they produce and update annually. We look at it and then we map out and strategize how each year we can issue, go to the capital markets and issue debt, and show them on a year-by-year basis, how much money they would get, per year, and then they work it into the opposite side, the expenditure column, and making sure that they have continuity in terms of their overall building program, whether it's painting an existing building or building a brand new building. And then in terms of issuing the debt, the school district in this example, they would adopt what's called a bond resolution. It is prepared by a legal counsel or bond counsel. Once they adopt that, then bond counsel becomes disclosure counsel, and they produce an official statement or a prospectus. We have a small role in the prospectus in that we provide all the numbers and all the aggregate debt service type of information. We then send that up to Moody's Investor Service and or Standard & Poor's, and we have contacts there. We schedule a call. We then have a call with the issuer. We get questions ahead of time, and then we go over a full credit makeup, of the school district in this example, and then the rating agency about 7 days later will issue an underlying credit rating. And then in the state of South Carolina and other states, and I've posted about this before, there is a state school enhancement programs. So in South Carolina, there's an additional program that if anyone does not make their bond payment, then the state treasurer advances funds. So that program actually has its own credit rating as well. And so 2 ratings are then issued. They are put on the official statement. We then post the official statement 7 days before the competitive bid or the sale date. It goes out over an internet platform called iPrio, and all the large institutions and small institutions across the country sign up to bid. And then on usually it's 11 a.m. But so at 11 a.m. on a Tuesday, Wednesday, or Thursday, we usually don't sell bonds on Monday and Friday. We accept bids, and then the lowest true interest cost wins. And then we take the interest rates that we receive, both coupons and yields. We resize the bond issue so it meets the overall plan. Send it to the underwriter for sign off. They sign off on it, and then we move towards closing. And about 2 weeks later, sometimes 3 weeks later, we physically close the bond issue. The money is wired to the county treasurer if it's a general obligation bond, or a trustee if it's a non-general obligation bond. And then the issuer completes their project, and that's and then we kind of repeat next year if it's an annual issuance type client, or some of our smaller ones that might be every 3 years that we go to market.
Hi, Robert McGroarty here, Director of Subscriber Development at Hedgeye. Hope you're enjoying our podcast. Start generating alpha with our suite of Sector Pro investing research products. Dive deep into retail, industrials, technology, and everything in between, with exclusive access to the sharpest analysts and actionable ideas on Wall Street. Go to the products page on hedgeye.com to subscribe. Enjoy the rest of this episode.
That's kind of the process.
Yeah, that's awesome. Really helpful. I appreciate it. And hopefully those listening in, that gives you just like a little bit of a background in terms of what Brian does on a regular basis and how he interacts with the muni bond space from an issuance standpoint. So why don't we pivot here and rotate back to kind of where many here on the call certainly kind of, I guess, spend a bit more time on, and that's actually how you kind of can leverage sort of muni bonds and that kind of thing inside of a portfolio. I know you've got a couple topics that you'd like to hit that you sent over to me ahead of time. So first of all, thank you very much for that. Incredibly helpful. But secondly, if you don't mind, maybe we could first tackle the kind of sort of how you come about or how you've created your goals. So I see David Salem's listening in. He was so thank you for taking that time, David. And he and I recently sat down and covered a topic called getting structured for investment success, right? So I think, it's brilliant to see that you have a similar mindset in terms of how you tackle the muni bond space, Brian, because it's really a trending theme. So for anybody who's listening in, having a structure, having some goals in place is really how you do this successfully, right? Whether you're to your point, Brian, whether you're Brian and you're tackling the muni bond space for the last 25 plus years, or you're David and you've been on the endowment side and managing a fund for again 20 plus years as well. Probably closer to 30 to be honest. But my point is that mimicking these mindsets of really great investors and people that have had a long lifespan in doing what they're doing and the specialization is really brilliant. And hopefully that's what those listening in will take home from this conversation with Brian and many others to come. But so Brian, I'll stop talking and I'll pass the book back over to you about some of those goals and that kind of thing that you set and how you think about the muni space structuring munis inside of your a portfolio. It doesn't have to be yours.
Sure. So, first of all, we're talking about fixed income, but we're going to focus on, tax exempt municipal bonds. So if you have money in an IRA and you try to buy a municipal bond on Fidelity, it's going to pop up and say not eligible because there's no reason to have a tax-free security in a tax deferred or a tax-free account. I just happen to find myself where I'm a little bit lopsided, where I have IRAs, but I have more in non-IRA accounts. So the tax exempt bonds play a pretty big role just for me individually, just the way that things kind of have played themselves out. So without getting into percentages and things, because Robert and I did talk about that, I just have a need to find a very tax efficient solution for investment dollars that are sitting in non-IRAs and taxable accounts, and tax exempt munis play a big role in terms of goals and objectives. This is me putting on the investment municipal advisor hat, but then trying to take advantage of what I'm thinking on that side, but finding an opportunity maybe on the individual investor side. And I'm not going to say it's easy. You do have to hunt and you do have to work. And it took me quite a while last year to build out where I'm at currently, because rates did shoot up quite a bit last year. But my basic goal and objectives when I buy a tax-free bond is I want to buy the longest term bond that I can get at the highest yield. That's my first criteria. Secondly, I want to have the highest probability that the bond is refinanced at the call date. And what that means is when you issue a bond, in that prospectus, it'll say the bonds are not eligible to be called for the first, say, 7 years or 8 years or 9 years or 10 years. It used to always be 10 years. And then there were some federal tax changes that put financial advisors in a position that sometimes we will do a 7-year for specific reasons. But 10-year par call is kind of the standard bread and butter. So the first 10 years cannot be refinanced, and then 10 years and out, you can be refinanced at any time. So when I buy bonds, right, if I buy in the 20-year space, or I buy in the 25-year space or the 30-year space, then I'm going to assume that every year that, say it's a 20-year bond, after a year, it's now a 19-year bond. And after 2 years, it's an 18-year bond, and so forth and so on. So eventually that 20-year bond becomes a 10-year bond, right? And it's eligible to be refinanced out. So when I look at buying bonds, I want to find and thread that needle where I'm going to buy a bond that is currently pricing to maturity. That means the probability that it gets called early is less than the probability that it goes to maturity. That's my first criteria. And then, secondly is the highest yield. And then what I do is, as I buy bonds, right, and we can go through the two examples that I posted, is you add your first position and your second, and your third, and your fourth, and your fifth, and your sixth. You're creating a cash flow stream, and so you would then kind of aggregate all of these individual bond cash flows to come up with your cash flow stream. And one of the things that I do before I start is I come up with what I want to earn per month, and then I times that by 12, and then I divide it by 0.04 for 4%, and that. So a couple of pieces there just to rehash. So number one is, when the bond comes out for bid or for purchase, I always try to buy the longest term at the highest yield. I try to buy right now a 4% coupon as opposed to a 3% coupon or a 5% coupon. And the reason is because right now, where the yield curve is, that bond is not expected to be refinanced at the call date. But in January, it was, when rates were a little bit lower. So rates have come up a little bit. So 4% coupons, kind of that toggling point between the assumption it gets called in early and not the assumption that it gets called in early in terms of how it's priced. And then my goal is to buy that 20 plus year bond, but then get paid off early at that first eligible call date, which is usually 10 years out. So that's my goal and objective in terms of buying a bond. Now, when I go out and I look for a bond, I have an underwriting criteria that is very narrow and very conservative. So first is, I only like to purchase essential service credits. And if you look at, say, Fidelity, and you go into their municipal bond area and you look at their criteria, there is going to be an area where it's called use of proceeds. So, where is the money going? And on Fidelity, they have 9 options. They have agricultural, education, government, hospitals, housing, industrial development, recreation, transportation, and utilities. I narrow those 9 down to only 3 areas. I'm only interested in education, which is going to be mostly public school K through 12 because of the state intercept programs that exist mostly. Number 2 is government, mostly local general government, which is going to be your courthouse project or a detention center project or a judicial center type project. And then utilities, right? That's flushing your toilet, whether you want the water side or you want the sewage side. So those are really kind of the 3 areas that I focus on. Oddly, when you look at funds, and we'll talk about funds a little bit later here, there is really no essential service only fund out there. I have searched and searched and searched. And that's another reason that I, have built out my own municipal bond portfolio by myself, as opposed to buying a fund. There's one fund that's kind of close to it, but it's not essential service only. So when you go out and you look at the various funds, you'll notice that none of them will say that they only purchase education, local government, and utilities. They just don't exist. My underlying rating, I typically like a single A category or higher. If it's a school bond, I typically like the state enhancement programs. Again, Fidelity has a PDF file. You can just type in, school district credit enhancement PDF of Fidelity, and it will automatically show up in your search engine, and it will list all the states that have the program and what the rating is. And it's all about state money being sent to the school districts being intercepted and make it a bond payment if there's a deficiency. If bond insurance is available, so a bond insurance company, there are 2 in the country that typically do most of the business, Build America Mutual and Assured Guarantee, so the short for BAM and AGM. They're rated AA. So if you have an underlying rating of single A and it's wrapped with bond insurance, there will be an additional rating of AA. So that's another layer of protection. And then that coupon, right? Right now, I'm targeting 4%. But last year in Q3 and Q4, I was able to buy some Kentucky school bonds at 4.5 that were pricing to maturity, not the early call. So you kind of got to watch on the coupon side. I saw a bond issue today on Fidelity at 4 1/8, so that's 4.125, and it was pricing to the early call, not to the maturity, and I didn't want to pay up for it, so that wasn't a bond that I'd be interested in. On a yield side, I have been typically buying at 4.25 and higher. That all started last year as the Fed started hiking rates and munis really kind of lost a bid. We started seeing 4.25 pop up. I bought a lot of bonds at 4.25, and then we had a period of distress in Q4, the beginning of Q4, where I bought some bonds in the secondary, some odd lots at like a 4.90, and was quite surprised that I was able to buy the same credits at a 4.90. And then lastly, again, when I look at the bond pricing on Fidelity, it'll, in whatever platform, and it shows you the price, they'll price it 2 ways. They'll price it to maturity, and they'll price it to what they call the worst, which is going to be the early call. And if they're equal, that means it's pricing to the maturity date. And if it's a 5% coupon bond, I can guarantee you it's going to price to the call date. And if it's a 3% coupon bond, the opportunity for that to be refinanced is very low. Therefore, it's going to price to the maturity date. The odds that it gets called is very, very low. And then lastly, in terms of buying an individual portfolio as opposed to buying a fund, I typically, try and always want to own 5 to 20 individual bonds or credits, and for a little bit of diversification purposes. And then on the sizing, and I get a lot of questions about sizing, the perfect size position is $100,000 or 100 bonds. And the reason is that if you ever wanted to resell it, you got to understand the person that's on the other side. When you hit sell on Fidelity's website and you tell them to sell the bond, they actually send that out over a platform, and they'll take bids for a number of hours from all kinds of secondary market players, and then they'll present you with the best bid. And you can either accept it or reject it. So if you're on the side of buying that bond from you and then reselling it to clients, if it's only five thousand bond increment, there's not a whole lot of money for them to make there. So there's got to be enough size. So the 100,000 is kind of the block size. That's the best. Not everybody's going to buy five $100,000 positions or 20 $100,000 positions. So in that case, I would say $25,000 increments is great to be at as well. But you can always look at it as I can have a bunch of small odd lots and then have an anchor position. So your anchor position would be one that is of, hey, I don't plan on ever selling any of these bonds. They're all hold to maturity. But if I ran into a situation where I did need to, unload it, this would be the position I would, because it's of size where I might get a little bit better bid than if it's something that's just a little bit less attractive. So that's kind of the criteria that I look for when I'm purchasing a bond. And I have an example that I can run through, Robert, if you'd like me to next, that I tweeted out earlier today, called Muni Spaces number 1.
Perfect. So I put that up in the nest. So for those listening in live on Spaces, we can just kind of pull that down. It's on the nest. It's actually on the far right. So it was the first one. I accidentally did it in reverse order, so apologies everyone. But I put up a couple little tweets from Brian over the last 2 days. But that Muni Spaces number 1 is there as an example, where you can go to his profile. It's there. I've retweeted it. So Brian, why don't you go ahead and do that?
Hi, Robert McGroarty here, Director of Subscriber Development at Hedgeye. Join our entire research analyst team live before the market opens for deep dive investing analysis, our favorite stock ideas, and our risk manager in chief, Keith McCullough's macro overlay. Our team of 40-plus equity analysts discuss key market developments, trends, and our high conviction long and short investing ideas. You will not get this granular level of insight anywhere else. A video replay, audio version, and analyst summary notes from the call are available shortly after each live show to ensure you don't miss anything. Go to the products page on hedgeye.com to subscribe and tune in live to the call weekdays at 7:45 a.m. Eastern. Enjoy the rest of this episode.
Before we get into that, though, I think one important thing to note, though, is for those that are either building out a new portfolio inside of the Muni space or adding to their portfolio, obviously, being price conscientious and not paying up for something, or paying something for what we would call the top end of the risk range, is incredibly important. So being conscientious as to what makes sense and what kind of additional bonds you might need or you would like to add to one's portfolio, to whether you're creating it for in aggregate for your RIA or individually as an individual person, individual investor. That 4.25 is a great threshold at the moment to be kind of to be aiming for. But at the same time, if the bond market, if the move starts to get moved down into more of the investable bucket, or certainly back towards like the $100 level, that the curve may look a little bit different than when Brian was building out his portfolio in kind of Q4 of 2022 and earlier this quarter as well. So just be conscientious of that. If you don't get 4.25, doesn't mean that you're building a shit portfolio. It just, different times provide you with different opportunities. So I just wanted to kind of call that out.
Yep, not a problem. So looking at Muni Spaces number 1 tweet, there are 3 pictures that I attached. And so the first one is at the top, it says official statement. And I've highlighted in red boxes some key features of the cover page of the official statement. So the credit is Woodford County, Kentucky. So that's actually adjacent to where I live. So I live in Fayette County, Kentucky. Next door is Woodford County, Kentucky. And Woodford County is it's a very wealthy county. A lot of your Kentucky Derby winning horses are born there. And, then they're resold at Keeneland Racecourse sales, and then they race them. So it's a good credit, right? It's just a very strong, wealthy area as my first look at a credit. The second thing after I kind of look at the name is at the top right, we have the ratings, right? So the rating of the school district, the A1 underlying rating, that is its own individual credit rating. And so the categories are AAA is the highest, and then you have three notches within the AA category. So you have AA1, AA2, and then the bottom would be AA3. And then you move into the single A category. So A1 is the top of the A category, A2 is the middle, A3 would be the bottom. And then after the single A category, for Moody's, you get into the BAA category. So BAA1, BAA2, BAA3. Lower than that, you get out of what we call investment grade. So you really do not want to be below investment grade. As an issuer, you definitely do not want to be below investment grade, especially in Quad 4. You get crushed in a Quad 4 environment. So when you hear on the macro show or ETF Pro or RTAs when they short JNK, that's getting out of the those are credits that are looking to potentially be in the junk category, and they're going to have some problems. So this clearly is a strong credit. It's a single A1 on its own. Then the A1 Moody's Enhanced rating, that is that state intercept program that I was talking about. So the school district, like all school districts, receive state funding, and that state funding can be intercepted where the state would receive notice that they need to not send it to the school district because they need to cure a shortfall in a bond payment and reroute those funds away from the district to make the bondholders whole while the school district figures out what happened. And then lastly, if you kind of look down at the bottom, you'll see the logo BAM. This bond actually is insured by Build America Mutual. And so there's a third rating attached to this bond. It's a AA rating from S&P. So there's three ratings in total. You've got the underlying rating of A1. You've got the state school enhancement rating of A1. And then you've got this wrapped with bond insurance as well that took it to the AA category. You see bonds like this that are 73 million get insurance because remember last year when things were a little dicey, people were scared, right? So retail likes insurance. It helps liquidity, especially on a $70 million Kentucky County bond issue, where it's their largest bond issue. So the second pieces that I wanted to point out that I highlighted is every official statement will say when the first interest payment is. So I bought this when they sold it as a new issue, not in the secondary market. So when I'm looking at it, I'm looking at the closing date, which is at the bottom. The bottom box says delivery of the bonds expected August 3rd. So that's the delivery date. So August 3rd, money changes hands. And then the first interest payment date would be on February 1st that I highlighted. And then I actually bought multiple maturities of this bond issue, but I highlighted the farthest out. So, and I actually did a tweet where there were 5 bonds of 2052 someone put up for sale, and I bid. This is the second day in a row that I bid them, and they didn't take my bid. So I'm going to bid them every single day until I wear them down. But so you can see that there was 8,855 bonds available that matured August of 2052. The coupon was a 4% to yield a 4.28, and then that computes to a price of 95 spot 294, and that's also, you can convert that to a percentage. So it's 95 spot 294% of 100. So it's it's what we call a discount bond. And so how does that work? Well, first, any day you want to see a bond that you own, the second pictorial is from a website called EMMA, EMMA. It is operated by the MSRB, Municipal Securities Rulemaking Board. That is an entity that creates all the rules that govern my firm and what I do for a living. But they have a retail-friendly website that they created so that the municipal bond market wouldn't be this opaque market that you could never get information on. So they created this from the fees that we pay, and it's free, and you can type in Google EMMA MSRB. You'll go to the website. You can type in the QSIP number of the bond, which is on the left-hand side, and I've circled the bond in red that we highlighted on the official statement that I own. And I can actually go in, and if I click that on the website, I can see all the trades. I can see the trade that I bought the bond at. I mean, that would be on there as well. So this website has so much information, all the continuing disclosure requirements, putting their audits out there, certain operating information. It's all required to be under that tab called continuing disclosure. And this entire website has been created really for the retail investor to have the same level of access that an institutional investor would have. So that is the second pictorial. And then the third is the cash flows. So this is kind of what's dear to my heart in terms of fundamental analysis. And that is, a bond is nothing more than a cash flow stream. And if you start with that premise, and when you decide that, hey, this bond meets my criteria, whatever that might be for you, if you simply put it on a spreadsheet, you will understand more about the bond and how it works than most people would just reading. So at the top, I've identified 4 columns: the date, principal, coupon, interest, total, cash flows to maturity, cash flows to first call date. So the first box area, right, on that official statement, I identified that the closing date or the settlement date was August 3rd. So that's listed there. And if you scroll across, if I purchased $100,000 or 100,000 par amount of bonds at 95 spot 294, I would have to cut a check for $95,294. And then beginning on February 1st, 2023, I would receive my first interest payment of not a full 180 days. So it'd be $1,978. And then on August 1st of this year, I would receive my second payment of $2,000. And then that would continue on, right? It's simply 4% times $100,000 is $4,000 a year. And so you get paid twice a year. Now, 2 things can happen. I can get paid off early at that first call date that I highlighted on August 1st, 2032, or I can get paid off at the final maturity date, which would be August 1st, 2052, or I actually could get paid off anywhere in between, because the first call date starts on August 1st, 2032, but the issuer may find themselves in a position that interest rates aren't favorable to refinance, so they wait, and maybe in 2036 they hit a interest rate pocket that makes sense to refinance the bond. They could do it then. But when we talk about the yield to maturity, in Excel, there is a formula called XIRR for internal rate of return. The X just simply uses the dates for a more accurate calculation. What you're basically doing here using that formula under the cash flows to maturity is you're saying on the negative, if I give you the minus $95,294, and then you give me on these dates $1,978, $2,000, all the way to final maturity on August 1st, 2052, $102,000, what is my total net return? What is the internal rate of return? That would compute to 4.322%. And that is really the time value of the cash flows being more accurate. And so the years to pay off is 30 years in the future. The stated yield, right on the cover page, the way we do bond math, is 4.28%. But this is a tax-free bond. So looking at the federal tax bracket of 37%, and then a Kentucky state bracket of 5%, we're actually reducing it right now, then it would compute to a taxable equivalent yield of 7.38%. So if you're in a tax situation where you're in a high federal bracket and you're in a state that has a decent state income tax, you can compute your taxable equivalent yield and say, hey, does 7.38%, is it fundamentally make a difference in my life? And, for me on a risk adjusted basis, when you look at municipal bonds, I was on a JP Morgan call, the default rate for municipal bonds, that includes everything, is 0.2%. So what's their default rate for, the small education, government, and utilities section that I'm only interested in? It's most likely less than that. So, if I bought Berkshire Hathaway stock and at the end of this year I decided to sell it and I made 7.38% and the capital gain wasn't protected, it was just ordinary income. I took a lot of risk in order to get to a net of 4.28% after taxes. Here, I'm taking very little risk, and I'm going to receive 4.28%. However, the taxable equivalent yield, right, what I would need to go look for in a CD or some other risk-on asset, or I should say a risk-on asset, would be equivalent to 7.38%. But that is not my goal, right? My goal in my criteria is I'm trying to thread that needle where I have a 4% coupon, and I'm hoping that I hit an interest rate cycle where I bought the 30-year rate, but I'm going to get paid off in 10 years. And so I did the cash flows to the call date. It's the same computation. The only difference is the time value of money. I get paid off on 8/1/2032 or in 10 years. And if you look, the internal rate of return, because you're receiving your principal back a little bit early and that little bit of capital gain, just a little bit less than 4%, the difference between the 100 and the 95,294, that's actually a capital gain. My internal rate of return is 4.641%, but I only got that bond for 10 years. Now, you can buy the 10-year bond if you want, and there was a 10-year bond available with this issue. It's just at a lower interest rate than if you were to buy the 30-year bond. And then the taxable equivalent yield, I don't run that off the IRR. I just run it off the stated yield. So I just wanted to notate that it's the same, right? Your taxable equivalent yield is the taxable equivalent yield for how that bond is pricing on that particular day, whether it's pricing to the worst to the call date or pricing to worst to the final maturity. It's really where that coupon lies and where current interest rates are. So that's an example of working through a bond that I would buy and how I'm trying to thread that needle to getting the highest yield, but I want to have the highest probability to be paid off on the first call date, but not actually have to pay for it. I'm going to play the interest rate game that we're going to have a yield curve cycle where it becomes favorable to refinance it. And you have to remember that I'm also on my, what I do for a living day-to-day basis, I work with school districts like this, monitoring this bond issue to figure out whether we can refinance it or not. So when I'm buying bonds, I'm looking at them and saying, if I was the financial advisor to this issuer, do I think that I'm actually going to refinance this bond or not? And I can look at it pretty quickly and tell whether or not I think it's something that I would refinance out or not. And there are a ton of different reasons why something might be opaque. Is it 100% state paid? I mean, why refinance a state paid bond unless that the state requires you to refinance it out? Is it is it 100% federal pay? There are some programs that were available during ARRA days where we issued bonds that were 100% federal paid. Well, my issuers aren't interested in paying to refinance a bond that there's no benefit to them. So, but mostly, bonds do get refinanced at least once in their cycle if there are 20 years. So that's an example of buying a bond that I would buy. My second example is buying a bond that I would not buy. And before I go to that, which is called Muni Spaces number 2, and it's the only other attachment that I have, Robert, is there anything that maybe I need to back up on or go over again?
No, that was a absolutely brilliant, very methodical way of walking through it. So no, you're spot on. So again, for those that are looking for the second example, just pull down the nest there on the top, scroll over, or if you're listening to this after the fact on the podcast or what have you, go check out at B, or you can check out my profile or our Muni guys at BG Nurick, Nurick. Go to his Twitter profile and you can pull up those examples as well.
Okay. So
awesome. And Brian, incredibly educational. I just want so thank you very much.
Sure. I love this. It's a labor of love. Okay. So I went on Fidelity today and I wanted to stay in Kentucky and I did my search criteria. And so the first There are four little pictorials. So the first is what I looked at on Fidelity, and I sorted it by highest yield to maturity. And so as you can see here, this is a Louisville, Jefferson County, Kentucky Metro Sewer District. It's actually a very highly rated entity. You can see it's in the AA category on its own. It's been around a long time. They issue a ton of debt. They're actually very sophisticated. They have interest rate swaps on some of their bond issues. This is not one of them, but they are actually a very sophisticated issuer. And so this is a bond that they issued. It's not on this page, the year it was issued. I think it was 2020 is when they issued this bond. So I highlighted in red two areas, right? So the first is the coupon. So the coupon is 2.25%, as opposed to the last example that was 4, right? The maturity date is May 15th, 2044. It's eligible to be called May 15th, 2028. And it has ratings from Moody's of a AA3, S&P of a AA, and then it shows the Moody's rating again, AA3. I don't know why they're showing the AA3 twice, but they are. So this is a very highly rated credit. But when you look at the ask and you look at the pricing, right, these bonds are selling for 66.897 cents on the dollar. And that is a function of the 2.25% coupon maturing in 2044, roughly just call it 20 years from now, versus current interest rates today. It is a depressed coupon because interest rates have risen. And so when you price it to the worst and you price it to maturity, it's the same, 4.75%. Well, why is that? That's because in today's interest rate environment, the probability that this bond issue gets refinanced is 0. Like, it's just 0. It's just a 0. It's not a 0 like Mike Taylor likes to call zeros, or Mark Cahotas likes to call zeros, but the probability that you're going to get paid off May 15th, 2028 right now is 0. And that's why the bond's pricing at 67 cents on the dollar. And that's why the yield to the maturity is 4.75%. But I kind of look at this bond as fool's gold, right? This is a bond that I get DM'd a lot about. Brian, I found this bond. Look at it's this very high yield to maturity. But the thing that they're not doing is they're not working through the spreadsheet to look at the cash flow. Because if they did that, they would uncover a few things. So let's go to the second picture, which is the cash flow sheet. So here, this is a bonds in the secondary market. And so I just chose that we would settle it tomorrow. So the settlement date is March 31st, 2023. It's in that box. The par amount's $100,000, but it's on sale. Remember, we only have to put up 66.897 cents per thousand. So total out of pocket's only $66,897. And so same thing as we did last time, except at a coupon of 2.25%, putting up less money granted, we receive our first interest payment on May 15th, $281. And then thereafter, we receive $1,125 every 6 months. And we look at the cash flow stream all the way to final maturity, and we also look at it to the first call date. But remember, the probability that this bond issue gets refinanced at the call date today is 0. So let's go down and look at the same statistics, the internal rate of return. This bond going to final maturity in 21.6 years is an internal rate of return of 4.758%. And that includes the difference between buying it for roughly $67,000 and getting $100,000. That is a capital gain. That is not tax-free. So that is. Number 2 is nobody in their right mind is going to sell you a bond that's going to be paid off at the call date that's going to kick an internal rate of return of 11.124%. Like that right within itself should tell you that in 5.1 years, the chances that this gets paid off early is a 0. And that's just where the market is. Now, if we go to Japanification yeah, maybe you do hit the lottery here, and I congratulate you, but it's not a bond that I would be looking to purchase. And even when you do the taxable equivalent yield, the way that taxable equivalent yields are calculated, you can see that it comes with the same federal and state tax bracket assumptions. It looks like it's 8.19%, but that includes that big capital gain, so it's kind of not. And so that's why most retail investors like to buy bonds that we call parish, right? They kind of price right in that 100% par, 99, 98, 101, 102-ish. That's really kind of the retail sweet spot where everything is a little bit easier and a little less opaque. So what I did here is on the left-hand side, I put capital gain, right? $100,000. You paid $66,000, $67,000. You got a capital gain of $33,000 a year. And that's there are some articles when you read about municipal bonds that'll say, like bonds doomsday. What they're really referring to is this bond. It's the unknowing investor that buys this bond and doesn't realize that they're going to have a capital gain, that it's not 100% tax-free to them, or federally tax-free and maybe state tax-free. And then the other piece is just most people buy bonds for a purpose, which is to live off of or have that income to then reinvest, like a drip strategy, into a risk-on asset. We've talked about that before. I've posted about it. So if you put up $66,000, $67,000 under the current income, bottom left, and you receive $2,250 a year, your current income is really a 3.36%. And as opposed to the bond I like to buy, mine's more in that 4% area, because I paid 95, 96 cents on the dollar on the first example. It's actually a little bit more than 4, but for, make it simplistic, you can see that, you're really not getting 4.75 in current income. Most of that 4.75 is actually in that capital gain that you don't realize until, 21.6 years from now. And, depending on your age, you might be dead. I'd be 72 years old. I don't know where I'll be, but that's quite a long time from now. So, buying municipal bonds and then looking at the cash flow stream, you start to get a little bit of a different picture about how this impacts your life. What role does this play in your asset allocation? Is it, a small amount? Does it have no role? Does it have a large role? What do I need to do or want to do with this money? And as you continue to build cash flow after cash flow after cash flow, if you get up to, say, 5 or 10 and you aggregate them, now you have a portfolio and you can manage that portfolio. So the last 2 pages are just the official statement. So you can see, what the bond issue is. It was issued in 2020, during QE. And I highlighted the bond on the last pictorial, which is the table that shows all the maturities, the coupons, and the prices and the yields. You can see exactly what bond is available for sale on Fidelity in the secondary market. I pulled this official statement off of the Emma website. So Emma is a great website for you to go on. You could actually go and look on Emma, or there's a link on Fidelity to it, but you could see the trade that occurred at what the dealer that's selling this bond on the platform, what they bought it at and what their markup is. That's how transparent Emma has made the world of municipal bonds. Most people never take that step. They never say, oh, well, this bond's being available in the secondary market. What did they buy it at, right? And you can start seeing, you'll see a lot of times somebody sold it for a ridiculously low price, and then it's being resold at a much higher price, and the dealer is going to make a lot of money. There are some fair dealing rules that take place, but just looking at that and understanding it will make you a better retail investor in terms of buying and selling bonds, and just kind of knowing what appropriate levels are in the secondary market. So this is the fool's gold example. This is the example of a bond that I would not buy, because I don't want to buy a 21.6 year bond, get current income that's only 3.36% to do fun things with, let's say, and then on top of it have a capital gain at the end. But you wouldn't know all of that unless you took the time to create the spreadsheet. So I just cannot stress it enough that creating the spreadsheet is a critical step. It's equivalent to the notebook for Hedgeye. I mean, you just have to do it. So, Robert, that kind of concludes my what I wouldn't buy example.
Totally. And I pinned a tweet from Coop, who's a good friend of ours, right, Brian, and I liked his tweet because it's my exact same thoughts, which is didn't even think of cap gains as opposed to zero taxes. And that example is just a prime and perfect example of how, to your point, like, whenever they end up calling that, you're going to have this huge cap gains component that you're going to have to deal with that absolutely royally screws up the whatever return on the investment you thought you were going into if you didn't do the math and the work as you stated, Brian. So yeah, super helpful.
Exactly. So if it's okay, Robert, now that we've gone through a bond that I would buy individually and a bond I wouldn't buy, and I live in Kentucky, we have a state tax, so that's important. If I lived in Texas or Tennessee where we didn't have a state tax, I could buy bonds anywhere in the country because there's no state tax. You want to talk a little bit about funds and ETFs?
Yep.
So
let's do that.
I am.
And,
Okay, so a lot of people that DM me or reach out to me, they don't have. They have a fixed income need. Muni bonds do fit a role for them, but they don't have enough to really go out and buy a hold to maturity portfolio, and it just doesn't make sense for them. So I'm not a big fund or ETF type guy because of the credit quality, but I've done a lot of hunting over the years, and I kind of have a couple funds, one new, one old that I like, and it's just some things to think about. The first is that most closed-end funds in particular run off leverage, and so every time I get on the weekly notebook review, I talk about the SIFMA rate, that 7-day weekly rate tax exempt rate that comes out. That's what they use to leverage bonds. So they buy a 5% coupon bond, and their cost of capital is SIFMA at 2%. There's a 3% spread, and they pass that back, through the fund to the investor. But that doesn't come without risk. And so leverage is great during QE, but leverage is not so great during QT. And there have been a lot of discussions on the notebook review about closed-end funds getting crushed. That 2.25% bond, I would guess, was probably in a fund at some point. Might have been part of a tender option bond TOB leverage, and they had to tax harvest it last year and get rid of it because SIFMA went up and they needed to get something new and needed to get a 4% coupon bond or a 5% coupon bond. So I don't really like leverage unless I feel really strongly about where the Federal Reserve is and where SIFMA is going to be pricing at to take advantage of leverage, because leverage can be your friend if it works right, but it does come with risks, and you need to be sure you read what those risks are. Secondly is the credit quality. So that essential service, the 3 out of 9 categories that I like to focus in on, when you look at the portfolios of these funds, you're going to find like toll road in some state, and you're going to be thinking to yourself, like, how does a toll road going to do in quad 4 when someone can just drive around it? Or a hospital, or Puerto Rico. There's going to be all these different credits that you would never in a million years buy on your own, but they're in these funds. And granted, they're have a lot of positions and it's diversified, but when you look at just your generic old school bond or your generic old water and sewer credit, there are less of those than there are these large authorities or MTA, which is the New York subway. Those seem to always kind of find their way into these funds. So I don't typically like the credit quality in the funds for starters. The second piece is duration risk, right? So if you buy a CD that's 2 years, in 2 years you get your money back. If you bought the CD last year at 3% and current rate's 5%, yeah, your CD is worth less, but it doesn't really matter because you're holding it to maturity and you're going to get your money back. The same thing goes when you buy a municipal bond and you hold it to maturity. As long as it doesn't default, you're going to get your money back. So the duration risk is a piece that a lot of people like to avoid. They don't like the duration piece. So most funds, right, they're a never-ending fund. They go forever. But there are new funds out that are target term funds. So the target term kind of started in the equity space for retirement portfolios, and then it's moved into the fixed income space. And so I've narrowed things down to kind of two funds that I like when I have to buy a fund. So the first one is, the ticker is MMIN. MMIN. It is a Mass Mutual. I'm sorry, I think it's MetLife fund. But the key characteristic of the fund is that it only invests in insured bonds. So the nice thing about only investing in insured bonds is that the insurance company has underwriters that do the credit analysis, and they are not going to buy credits that are bad credits. And a lot of the insurance companies that did not survive the financial crisis because they invested their premiums in mortgage-backed securities that were AAA that turned out not to be AAA. There's a lot of lessons that were learned during that period of time. And so the underwriting standards, being on the side that goes to them to ask for bonds to be insured, they do a very, very good job at screening the credits. And so this Mackay Municipal Insured Fund, ETF, only invests in insured paper. And by default, when you look at the portfolio, it is a lot of essential service credits. And so because of that characteristic, it's the only fund that I've found that invests in insured paper only, you sort of default into a lot of essential service credits. And being that the insurance is AA, a lot of the issuers, in order for it to make sense mathematically, are in the single A category. So they're a single A credit, they pay a premium for the insurance, they wrap the bond with the AA, and it goes out to the market as a AA rated piece of paper with an underlying of single A and gets a better interest rate. So that's how that fund works in terms of credit quality. And, you can research that fund and see if it's something that's appropriate for you or not. I've owned it before. I do not own it currently, but it's a non-leveraged fund. The other fund is a target term fund, and the ticker symbol is BMN. Now, there is a sister fund, I talked about it yesterday, called BTT, and it's a BlackRock product. And they buy credits that I don't necessarily love, don't necessarily hate every credit that's in BMN. There's 81 credits, 81 issues in the portfolio, and it's a brand new fund. It actually started at the end of last year, and the great thing about it starting at the end of last year is that they couldn't leverage it. So when you read the prospectus, it talks all about leverage, goes through all of the disclosure on risks of leverage. But they didn't leverage it because they really kind of couldn't, right? SIFMA was too high. Didn't make sense to take on that risk. And so it's currently yielding 4.5%. It's the current distribution rate. We've gone through a lot of the credits, and they're kind of normal credits. Some I don't like, but again, there's 81 of them, so it's pretty diversified. And the duration risk is mitigated to a degree because it's a target term. So in September, I think it's 2037, September of 2037, their goal is to have issued each share for $25 and to then redeem each share and close out the fund for $25. And that's the same thing as BTT. The difference is BTT is running on leverage and is trading at like $21 and change, $22 a share. And, I've got some concerns about that fund because of the leverage piece. Well, here you just happen to walk into a fund that is supposed to be leveraged, but it's not because of the current interest rate climate. So I actually have a position in BMN. I'm not recommending it to anybody. If it's something that, you fit that profile, talk to your fiduciary or your trusted advisor, and they can, make them aware of it. And maybe it's something that you review together, and it's something that is appropriate for you if you're looking to get in the municipal bond space. But those are kind of the two funds that I focus on. And the best thing about funds, right, you can kind of buy and sell them every day. They may not be the most liquid product, so you can put a bid out or an ask out, and it might take all day for it to hit or a few days for it to hit. But it's more liquid than owning an individual bond. And then you have diversification, right? You're owning you're part of a consortium that owns a lot of different credits, and you're relying on those managers that get paid a fee to screen those credits and make sure that you're in credits that make sense for you. But they're not state specific, so they do break out the percentage of exposure they have to each state. And BMN I know is about 17 to 18% in New York. So if you're in New York and you buy a BMN, a portion of the portfolio is going to be exempt state-wise. Whereas if you're me and I do own BMN, I assume I'm going to get the zero shelter from Kentucky state income tax. So that's kind of it on the fund side in terms of what I look at, what I see. Again, most of the funds that I see when I go through the holdings, they just don't meet my underwriting criteria of essential service, education, government, utilities. They're kind of all over the spectrum.
Hi, I'm Keith McCullough, and I wanted to introduce you to my favorite product at Hedgeye, the Macro Show. Why is it my favorite product? Well, it's my show. I do that every morning. If you want to get ready for the market day, you want to contextualize all the data, you want to make good decisions, then this is what you should be watching. It's a repeatable process that you can deliberately study, measuring and mapping time series to time series of data. So it's not going headline to headline and getting whipped around. It's actually being so much more dispassionate about it and making good decisions that are data driven. So we'd love to have you on our team. Come join us.
Tune in weekdays at 9 a.m. Eastern and on demand anytime. Go to hedgeye.com/research to subscribe.
Robert, did I do a good enough job on that?
Yeah.
Bland enough?
Brian, you've done a great job. And just for those that are looking for it, I actually posted his notes from the weekly notebook review up in the Nest as well, and that actually runs down. It gives you a brief synopsis, kind of what you just talked about in regards to those two funds. BMN, I just pulled up, and it's trading right at 25.01. So if you're going to get it back at 25, again, just good thing to have on your radar. And as you pointed out, Brian, could be a good diversification. But
it pays monthly. I forgot.
Well.
Both those funds pay monthly as opposed to semi-annual. So that's another feature that a lot of people like.
Yeah, that was the other thing too. I saw, BMN puts out like a 9 cent dividend approximately on the mid-month, which is always of interest as well. But all right, so I've got about 20 minutes left, 25 minutes before we hit South Station here. And so why don't we open it up to maybe a question or two to the crowd. If anybody wants to jump up, we can go that route, or we can also, we have one other subject that I think we wanted to hit.
Kind of where to hunt, where to look for.
But I'll just see if anybody. Yeah, exactly. So I'll actually, you know what? I apologize. I'm going to keep the questions to crowd. Oh, here comes Jason. All right, we'll let Jason come up. If you're enjoying this, I don't know. This has been phenomenal, Brian. So thank you again. Jason, welcome to Hedgeye and Friends, Muni Bond edition. Hopefully you've been enjoying this conversation as much as I have.
Yeah, I have. Thank you for hosting in. And Brian, pleasure to listen to you. I don't know what it is about that part of the country. There's a lot of Muni specialists out there. I worked a lot with Finding Sparks over the years. They got absorbed by Stifel, and they were always a pleasure to work with, very knowledgeable. So I should probably take a trip down there. I'd learn a lot about munis. Question: I saw a Refinitiv screenshot in the Nest, and I'm wondering. I just saw it, so I use Bloomberg to buy munis for our clients. I work with some dealers. I'm wondering if you use Refinitiv to purchase munis at all, and what the dealer network is like on that platform.
That is a great question. So actually our subscription, I call it TM3. So our subscription to TM3 is to get access to the MMD so that we can look at the AAA scale for the day. We can look at the early, the mid, and the final read of what's happening in the market. When we get audited by the SEC and it's a negotiated deal, they ask if we, on behalf of our issuer, if we're tracking MMD and spreads and making sure that our clients are receiving fair market value. In the platform, I get access to the Muni Center. And so the Muni Center is a platform that dealers trade secondary market bonds. And so that's what you're kind of seeing is I actually go in there and I have a search parameter that I go into, and I can find bonds that are listed there. But Fidelity's website actually links to the Muni Center. So sometimes I'll go to my search in TM3, I'll see the QSIP, I'll go to Fidelity, I'll just paste the QSIP in, and I'll click on it, and the bond will show up, and I'll bid it. So so what you're seeing is me going to the Muni Center, but Fidelity actually has a link to the Muni Center. You just don't see it under that platform. Does that make sense?
So yes, and so it sounds like the platform's growing then.
Yeah, I think it started with MSRB and Emma, right? That was a big undertaking, and with that product, the people are getting more savvy, and you've got like when I'm taking deals to market, in particular negotiated deals, SMA accounts are becoming a huge buyer of bonds. So you've got family offices that have very sophisticated people that are looking at both taxable and tax exempt investments, and they're buying what makes sense for them and putting in bids where normally they wouldn't even get access. But the platforms and technology have expanded to where they have much more access than before.
I had a follow up if it's okay, Robert, if you don't have any objection.
No, go right ahead, Jason.
Okay. I'm thinking. I think about the probabilities of like some kind of market event or dislocation with vol and fixed income at like super high levels. I also look at muni treasury ratios that I think were pretty rich coming into the year. And I think 80-90% typically represents a pretty strong sell signal for large institutions, banks, maybe, if you will. And with what's going on with deposit flight, I wonder if munis are in the crosshairs for maybe freeing up cash at some of these large institutions. Is that something that's on your radar at all? Is this kind of pie in the sky thinking? This is kind of some things that I'm maybe worried about as I need to kind of be mindful of client capital. So anyway, just your thoughts on that, and that's
Sure.
kind of just your
Sure.
opinion.
So
Go ahead.
I'm going to answer it two ways. So the first is, let me answer it from the individual Brian, right? Like I'm buying bonds and so forth. So when I approach municipal bonds and I buy an individual bond, it's hold to maturity. So I really kind of don't care what happens the day I buy that bond and the day I get paid off, whether it's the call date or the maturity date. So I'm not managing like a portfolio from a trading perspective, right? So there's trading rates and buying rates to me. The way I approach municipal bonds and that allocation is that money is locked up. I never need access to it. I want the income stream, and I have a plan for that income stream. And I make sure that I size it appropriately. If I'm going to trade rates, that's going to be more on the fund side for me. Like I'll buy a BMN, I'll take a position in it, and I really like the fund, and I'll take the risk that it stays very low fees because they haven't leveraged it to be able to take higher fees. And if they do leverage it, I hope it's going to be in the right environment, and it's a good money manager, and I'm going to actually get a higher payout than I am today, and I'm willing to take that risk. But again, that's a target term fund, so I'm not going to sell that fund at anything other than 25. So if the NAV drops, I'll just hold it. Like I don't have a problem holding it. I go into it on an HTM basis as well. So if you're managing somebody's money and you're concerned on the liquidity side, like you're having to watch the NAV on them, the first question I would have is, what is the goal and objective for those funds? Because that's not a position I would be in on an individual investor position. I wouldn't put myself in that position. I don't buy rates that way. So the second part is as an advisor. So right now, and this is a really good timely question. So I've had 3 meetings this year that they're all high quality credits. And one of them is looking at a $90 million jail and a $40 million recreational park. One of them is looking at a roughly $100 million detention. We don't call them jails anymore. Detention center. Sorry. I'm not allowed to call them jails anymore, apparently. Detention center. And the other project is it's a really large bond referendum. It's a $400 million bond referendum that we're working on. All the credits are AA. And so I walked them through that during QE. When I brought bonds to market for them, we worked really hard on their credit ratings. They didn't really get that great of a benefit between a single A credit, right? I mean, you're in QE. Credit spreads are compressed. 20 basis point differential, 15 basis point differential. It's not that big. In a distress environment, it's the opposite, right? Like the spreads widen out and they get to take advantage of everything. So I'm sitting here explaining to them why they have great governance, great management, and great external consultants. They're going to be able to take advantage of headwinds that come their way. And it'll be just like 2010 and 11, where they got access to, falling labor prices, falling, crashing commodity prices and crashing interest rates. So I kind of see it the opposite. Now, if there is a distress period, it's typically kind of short-lived, right? Because distress means people run to U.S. Treasuries first, and then munis become the value trade. Because as you said, people run the spread to Treasury calculation, and the default risk on essential service is just so low. It's not as low as the federal government because there have been defaults, but it's extraordinarily low. So I'm not trying to dodge your question. I'm trying to answer it in terms of like how I look at things from both prisms. If there is distress in the muni market, like we saw in beginning of Q4 last year, I'm going to be like a predator on an individual investor side in the secondary market, buying up bonds at like a 490. Like I explained earlier, I bought, a 50 block, a 75 block, at anywhere from a 460 to 490. On the issuer side, my issuers, they don't have to issue the bonds then. We can just wait, right? If I'm in a distressed period, I know that January is the slowest month of the year because nobody in government works in December. So they're not putting bond issues together. So I actually time bond issues to go the third or fourth week of January every year for my credits that, are in that position. That's when they need the funds and their management is willing to, position themselves to work and go through the process to bring a bond to market in a time that, they're mostly on vacation. Does that help?
Your thoughts are always helpful. Is it too soon for high yield munis here, given where we may be headed in the cycle?
So when you kind of default back to my essential service credits, I don't think high yield would make it for me, right? And I actually don't do hospitals. I don't do nursing homes. I don't do things that can default or become distressed from a repayment perspective, because it actually costs you a lot of money to manage headaches like that. So I stay in, like I said, the local government, school, county, city, utility space. I don't venture out into port authorities or, transportation, toll roads. It's just not what I do. Not something I enjoy doing, nor do I do that. So high yield is really something that I don't play in that space, and I wouldn't be a good barometer for you.
Okay, I appreciate it, Robert. Thanks for letting me to come up, allowing me to come up.
Yeah, absolutely, Jason. It's great questions there and really good, just awesome stuff. So appreciate it. Brian, I'm unfortunately going to have to cut this one a little short. I apologize. I think we could really be having this conversation for probably another hour. The quality is absolutely spectacular. So thank you very much, Brian, for all your efforts and time and putting together your thoughts here for us. We'll have to do a session number 2 at some time in the near future. But thank you again, sir, for taking the time to educate Hedgeye Nation. We greatly appreciate it.
Yeah, just kind of in closing, whatever platform you use, there's a fixed income section. There's always things to click on and read. I think you'll start to, listen to this and it'll start making sense of what you see. Remember, create a plan for your income stream as a vision. And then, I talk a lot on the notebook that I'm not really doing a whole lot in the equity side. I've spent my time creating the fixed income side where it's kind of set it, forget it, hold it maturity. And then I'm looking forward to really getting active in, quad 1, 2, and 3 on the equity piece and have this kind of behind me. So that's kind of how I'm approaching things. And, everyone has a little bit different process, but enjoyed the conversation.
Yes, sir. I appreciate it. Absolutely. All right, guys. We'll see you at Weekly Notebook Review on Wednesday, 4:30 p.m. And they got a beginner's guide tomorrow morning at 11:30. So check that out if you're a Hedgeye subscriber. Again, appreciate your time, Brian. Jason, thanks for jumping up and asking some really high quality questions. So thank you. Hope you enjoy it, and we'll see you back here soon.